Most VOO versus SCHD comparisons get stuck arguing about the wrong things: which one has a higher yield, which one is safer, which one performed better over the last year, and none of those arguments actually answer the question that matters most to you as an investor. Which one puts you in a better position 10, 20, 30 years from now, given what you specifically want your money to do? That is the question almost nobody asks properly. And when you do ask it properly, the answer becomes far less obvious than either side of the debate usually admits. Today I am going to compare VOO and SCHD the way that question deserves to be answered. I am going to put the same $100,000 into each one, leave it alone for 30 years, and show you in detail where each portfolio ends up, how large it grows, how much income it generates, how it behaves when markets get difficult, and what the actual lived experience of holding each one looks like across different environments. By the end of this video you will understand exactly what trade-off each fund is asking you to make, and you will be in a position to make that choice based on what your financial life actually needs. Not based on which side of an internet argument sounds more convincing. The 30-year projections at the end of this video reveal a $950,000 difference in portfolio value on one side and an $18,000 per month income difference on the other. Both of those numbers are real, and both of them matter. The question is, which one matters more to you? Let's find out. Before we look at any performance numbers, I want to make sure you understand what you are actually buying with each of these funds, because the different results they produce are entirely a function of how differently they are built. VOO and SCHD are both ETFs, both are low cost, both are passively managed. But they are designed to do completely different jobs, and choosing between them without understanding that design difference is like choosing between a pickup truck and a sports car without knowing what you need to haul. VOO is the Vanguard S&P 500 ETF. It tracks the S&P 500 index, which means it owns approximately 500 to 505 of the largest publicly traded companies in the United States, weighted by their market capitalization. The biggest companies get the biggest slice of the fund. Right now that means Apple, Microsoft, Nvidia, Amazon, Alphabet, and Meta, the largest technology and technology-adjacent companies in the world, account for a very significant portion of the total portfolio. Technology as a sector makes up roughly 30 to 35% of VOO's holdings. VOO does not screen for profitability, dividend history, or financial quality beyond what is required to be a large public company. It simply owns the 500 largest, weighted by size. The underlying thesis of VOO is elegant and well proven. The largest American companies, in aggregate over long periods, grow, and owning them all in proportion to their size is the most efficient way to capture that growth. The expense ratio is 0.03%, essentially free. VOO manages approximately $850 billion in assets and is one of the largest ETFs in the world. SCHD is the Schwab U.S. Dividend Equity ETF. It tracks the Dow Jones U.S. Dividend 100 Index and holds approximately 100 to 103 companies, chosen not by size, but by a set of quality criteria centered around dividend consistency and financial strength. To be included in SCHD, a company must have paid dividends for at least 10 consecutive years. Then it is evaluated on 4 specific financial metrics: cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. Only companies that pass all those screens and rank highly on those metrics make the cut. This process creates a portfolio that looks nothing like the S&P 500. Technology stocks make up only about 8% of SCHD, compared to 30 to 35% in VOO. The largest sectors in SCHD are energy at roughly 19%, consumer staples at around 18%, and healthcare at around 16%. These are defensive, cash-generating businesses, companies that tend to maintain earnings and dividends even during recessions. Top holdings include AbbVie, ConocoPhillips, Chevron, Home Depot, and Cisco. The expense ratio is 0.06%. SCHD manages approximately $80 billion in assets. Those design differences are not just cosmetic, they explain every difference in performance, income, and volatility that we are about to walk through. VOO is built for capital growth. It owns the companies most likely to grow their earnings and therefore their share prices over time. SCHD is built for income growth. It owns the companies most likely to sustain and increase their dividend payments over time. One is optimized for your balance to grow. The other is optimized for cash to flow to you regularly. Keep that distinction in your head as we go through everything else, because it is the key to understanding all of it. Let us start with dividends and income because this is where the two funds diverge most visibly in the short term, and it shapes investor psychology significantly from the very beginning. VOO does pay a dividend, currently around 1.12 to 1.13% yield annually. On a $100,000 investment, you would receive approximately $1,130 in your first year in dividends. That income exists because the large companies inside VOO, including consumer staples companies, financials, and healthcare names, do pay dividends, but income is genuinely not what VOO is about. The fund's dividend growth rate over the past decade has been roughly 6% per year, which is decent but modest. In the early years of investing in VOO, the dividend income is small enough that most investors barely notice it. The fund's job is to grow your balance, and that is where your attention will naturally go when you hold it. SCHD is a fundamentally different income experience. The current yield is approximately 3.7 to 3.8%. On the same $100,000 investment, you would receive approximately $3,780 in your first year in dividends, more than 3 times what VOO pays. But the more important number is the dividend growth rate. SCHD has grown its dividend at approximately 10 to 11% per year over the last decade. That growth rate is the mechanism that transforms SCHD from a fund paying you 3.7% today into something dramatically more powerful over 20 or 30 years. At 10% annual dividend growth, a dividend payment doubles approximately every 7 years. After 30 years of compounding at that rate, the original yield on your initial investment is not 3.7%. It is many multiples of that, and we will see exactly what that means in the projection numbers later. The psychological effect of dividend income is also worth talking about honestly, because investing is not just mathematics, it is a human experience, and how an investment feels while you hold it affects whether you actually hold it. With VOO, progress is mostly invisible in the short term. Your balance grows, but in a volatile, unpredictable way. Some months it jumps, others it falls. The dividend arrives, but it is small enough to barely register. The investment requires patience and a tolerance for watching a number that fluctuates without giving you much tangible evidence that it is working for you. With SCHD, the experience is different. The dividends arrive every quarter. They are large enough to notice. They increase every year. During periods when the share price is flat or declining, those dividend payments are proof that the investment is still functioning, still generating income even when the price chart is not cooperating. For a certain type of investor, that consistent reinforcement makes a meaningful difference in their ability to hold long-term without abandoning the strategy. Now let us talk about price growth, because capital appreciation is ultimately where the largest gap between these two funds emerges over long periods. VOO's historical annual price appreciation over the past decade is approximately 13.9% per year. SCHD's historical annual price appreciation over the same period is approximately 9.2% per year. At first glance, a 4.7 percentage point difference in annual growth does not seem catastrophic. Over a single year on a $100,000 investment, it represents about $4,700, meaningful but not staggering. The compounding math is where that gap becomes genuinely significant. Compounding does not add returns. En het schatsmijn, urjan dit naam omberdans, en schatsten. In nabin schatsten died it multiplies them. Each year's gains become the base on which the following year's gains are calculated. A fund growing at 13.9% per year doubles roughly every 5 years. A fund growing at 9.2% per year doubles roughly every 8 years. Over 30 years, those different doubling speeds create a portfolio size difference that is very large. And this is before accounting for reinvested dividends, which add additional compounding fuel to both funds, but add proportionally more to SCHD because the dividends being reinvested are significantly larger in dollar terms, especially in the later years when dividend compounding is most powerful. Looking at actual historical returns across different time frames makes this concrete. Over the past year, VOO returned approximately 17.8 to 18.8% in total return, while SCHD returned approximately 4.3 to 15%, depending on the specific measurement period. SCHD had a challenging year of relative underperformance in 2025 as technology leadership drove markets. Over the past 3 years, VOO has gained roughly 71 to 75%, while SCHD has gained approximately 14 to 15%. Over 5 years, VOO has delivered approximately 79%, while SCHD has delivered roughly 33%. And over the full decade, VOO's price appreciation has been approximately 255%, while SCHD has gained roughly 132% in price terms. Those gaps are real, and they reflect a fundamental difference in what each fund owns. The tech-heavy S&P 500 has been the most powerful, return-generating machine in the world over the last 15 years. SCHD's deliberate underweight to technology and overweight to defensive dividend-paying sectors has cost it meaningful price appreciation relative to the S&P 500 during this specific period. The honest context for that comparison is important, though. The past decade has been historically exceptional for U.S. large-cap technology stocks. The performance gap between a tech-weighted index and a dividend-quality index over this specific 15-year window is partly a reflection of genuinely extraordinary tech dominance that will not necessarily repeat at the same magnitude. SCHD significantly outperformed VOO during 2022, a year when rising interest rates hammered growth stocks while SCHD's defensive holdings held up much better. It also outperformed through the 2020 COVID recovery period in dividend growth terms, even as both funds fell sharply in the initial sell-off. The right framing is not that VOO always beats SCHD, it is that VOO tends to lead during technology-dominated bull markets, and SCHD tends to lead or hold up better during rate-sensitive or recession-driven environments. Your view on how the next decade plays out relative to the last one is a legitimate input into this decision. Risk and volatility deserve their own focused conversation because this is where many investors find out whether they actually have the temperament they thought they did. VOO tracks the full S&P 500, which means its beta, its sensitivity to broad market movements, is essentially 1. When the market falls 10%, VOO falls approximately 10%. When the market falls 30%, VOO falls approximately 30%. The 22,003 buying Somber Cinnabine Squinny Dodi buying Odesign Huntodon drawdown for VOO was approximately 25% from peak to trough. In 2020, during the COVID crash, VOO dropped roughly 34% in about 5 weeks. These are real numbers that real investors had to live through. The technology and growth stocks that drive VOO's strong returns are precisely the stocks that fall fastest and furthest when sentiment turns and when interest rates rise sharply. For an investor with a genuine 20 or 30-year time horizon, who can hold through those drops without selling, the volatility is the price of admission for the superior long-term growth. For an investor who discovers in the middle of a 30% drawdown that they cannot hold, who sells at the bottom and crystallizes a permanent loss rather than participating in the recovery, that same volatility is catastrophic. SCHD's volatility profile is meaningfully different. The fund's beta has historically been approximately 0.80 to 0.85, meaning it typically absorbs about 15 to 20% less volatility than the broad market. In 2022, when VOO fell approximately 25%, SCHD fell roughly 16%, a significant difference in drawdown magnitude that translated into a real difference in investor psychology during that difficult year. SCHD's defensive sector tilts, energy, consumer staples, healthcare, financials, tend to hold up better during corrections because their revenues and earnings are less sensitive to economic slowdowns. Importantly, dividends keep arriving during SCHD drawdowns even when the share price is falling. For investors who are drawing income from their portfolio or who find that consistent income payments help them stay invested through volatile periods, that combination of shallower drawdowns and continued income is genuinely valuable. The trade-off is the same one we have already discussed. You are accepting lower price appreciation during strong bull markets in exchange for a smoother ride and more defensive characteristics during stress. Fund size and liquidity are worth a brief mention because they have practical implications for larger investors. VOO manages approximately $850 billion in assets and trades millions of shares daily with extremely tight bid-ask spreads, buying or selling any amount, bor sober, offer some sober now, or kin sober, or from a few $100s to millions of Bauber, o wine sober nabber, executes quickly and precisely at the market price. SCHD manages approximately $80 billion, still very large and highly liquid by any normal standard, but operating at a fraction of VOO's scale. For most long-term individual investors, this difference is irrelevant. If you are placing trades over $500,000 or if you need to move large positions quickly, VOO's superior liquidity becomes more meaningful. For retirement investors making regular quarterly trades, neither fund presents any liquidity challenge. Now the projections. Same $100,000 starting investment in each fund, no additional contributions, dividends reinvested in both cases throughout the full 30 years. Let's see where each portfolio ends up. For VOO, the projection uses a 13.92% annual price appreciation rate based on the historical decade average, a starting dividend yield of 1.12%, and a dividend growth rate of approximately 6% per year. After 1 year, the portfolio is projected to be worth approximately $115,040. After 10 years, approximately $395,000. After 20 years, approximately $1.5 million. After 30 years, approximately $5.59 million. The composition of that final value tells the VOO story clearly. Of the roughly $5.49 million gained over 30 years, more than $5.4 million comes from capital appreciation. Dividends contribute approximately $80,000 in cumulative reinvested income over the full 3 decades, a meaningful number, but genuinely a supporting role rather than a lead role. The annual dividend income generated by the portfolio in year 30 is projected at approximately $5,081. About $423 per month in passive income. The VOO portfolio after 30 years is overwhelmingly a capital wealth story. You have a $5.59 million asset. The income it generates is modest relative to that asset value. The wealth is real and extraordinary, but it is stored in the balance rather than flowing to you as cash. For SCHD, the projection uses a 9.23% annual price appreciation rate based on the historical decade average, a starting dividend yield of 3.59%, and a dividend growth rate of approximately 10.61% per year. After 1 year, approximately $112,120. After 10 years, approximately $341,000. After 20 years, approximately $1.22 million. After 30 years, approximately $4.63 million. The composition of that final value looks very different from VOO. Of the roughly $4.5 million total, approximately $2.96 million comes from capital appreciation and roughly $1.57 million comes from reinvested dividends compounding over 30 years. Dividends do not play a supporting role in SCHD over 3 decades. They are a co-lead alongside capital appreciation, contributing close to 1/3 of the total portfolio value. The annual dividend income generated by the SCHD portfolio in year 30 is projected at approximately $215,998, roughly $18,000 per month in completely passive income. That number is the result of starting with a 3.59% yield, growing it at 10.61% per year for 30 years, and reinvesting every dollar along the way. The compounding of a growing dividend payment over 30 years creates something that a 1.12% yield with 6% growth simply cannot match in income terms regardless of how large the total portfolio grows. Placed side by side, the comparison is stark. VOO after 30 years, $5.59 million in total portfolio value, generating $423 per month in dividend income. SCHD after 30 years, $463 million in total portfolio value, generating $18,000 per month in dividend income. VOO wins on total portfolio value by approximately $950,000. SCHD wins on monthly income by approximately $17,570 per month. That is not a small difference in either direction. A $950,000 larger portfolio is genuinely significant wealth, but $18,000 per month versus $423 per month in passive income is the difference between financial independence and supplemental income. Depending on what you need from your money in 30 years, one of those gaps will matter to you enormously, and the other will matter relatively little. A retiree who needs their portfolio to pay their living expenses every month without selling shares will care far more about the income gap than the balance gap. An investor who plans to leave their portfolio to heirs or liquidate gradually will care more about the balance. Let me give you the framework for deciding which fund makes more sense for your situation, because the decision is ultimately not about which fund is better in the abstract. It is about which fund is better aligned with what you're actually trying to do. There are 3 questions worth asking yourself honestly. The first is, what is the money for? If your goal is to accumulate the largest possible asset over a long time horizon, to maximize what you leave to your children, to build a capital base you can sell down gradually in retirement, or to achieve a specific net worth target, VOO's superior capital appreciation makes it the stronger choice for that goal. The compounding of capital growth at 13.9% annually over decades is genuinely powerful, and the final portfolio value is meaningfully larger. If your goal is to generate income that covers your living expenses without selling assets, to reach a point where your dividends pay your bills and you never need to touch the principal, SCHD's income compounding machine is designed specifically for that outcome. $18,000 a month in dividends at year 30 from a single $100,000 investment is a retirement income story, not a balance sheet story. The second question is, how do you actually behave during market downturns? This is the most honest question and the hardest one to answer accurately before you have experienced a real drawdown. Most investors believe they can handle volatility when markets are rising. Significantly fewer can hold without panic selling when their portfolio drops 25 or 30%. Their financial newsfeed is full of recession warnings, and every instinct is telling them to protect what they have left. If you have held through multiple serious market corrections and genuinely did not consider selling, VOO's higher volatility is something you can accommodate for the higher growth it delivers. If you have not been tested in a serious bear market, or if you already know from experience that you feel physically ill watching your account value fall, SCHD's shallower drawdowns and continued income stream may allow you to stay invested through the bad periods in a way that VOO's volatility simply will not. The third question is, what stage of investing life are you in? In the accumulation phase, the years when you are contributing regularly and not yet drawing from the portfolio, VOO's superior total return compounds the fastest and maximizes what you have when you eventually reach the distribution phase. In the distribution phase, the years when you need the portfolio to pay your expenses, the income characteristics of SCHD become far more practically useful. Many investors who understand this end up holding both VOO as their core growth accumulator during the working years, and adding SCHD as a larger allocation approaches closer to retirement when income generation becomes the primary need. The two funds are not necessarily an either-or choice. They can serve complementary roles at different stages of the same investor's journey. One final observation before I close. The comparison we have run today uses historical return assumptions based on the last decade, which has been unusually favorable for U.S. technology stocks, and therefore unusually favorable for VOO relative to SCHD. Whether the next 30 years look like the last 15 is genuinely uncertain. If technology leadership moderates, if interest rates remain elevated in a way that pressures growth valuations, or if the defensive sectors that SCHD owns experience a period of outperformance as global uncertainty drives demand for quality income, the gap in capital appreciation between these two funds over the next 30 years may be considerably narrower than the historical numbers suggest. Past performance, as always, is not a guarantee of future results. The right decision is the one that serves your specific goals, tolerates your specific temperament, and aligns with your specific time horizon, not the one that won over the last decade or sounds best in a YouTube comment section. If this breakdown helped clarify your thinking, hit the like button and subscribe. I release new content on ETFs, portfolio construction, and long-term wealth building regularly. Drop a comment below and tell me which side of this comparison you land on and why. I read every single one and genuinely find it interesting to see how different investors weight the trade-offs. I will see you in the next one.